Welcome back to The Explainer. I am absolutely thrilled you're here today because we're doing something really special. We're putting on our expert investment analyst hats to perform a masterclass-style stock analysis. Our target? Entergy Corporation, ticker symbol ETR. But we aren't just looking at standard metrics today. No, we are going to evaluate this stock through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before capping it all off with some rigorous quantitative models, like the discounted cash flow analysis. So if you love a structured deep dive into the numbers, you are definitely in the right place.
Okay, let's dive into this. Here is our itinerary for today. We'll start with a quick company snapshot. Then we'll move through the Buffett, Lynch, and Graham lenses. After that, we'll look at DCF and alternative models, and finally wrap it up with our synthesis and final verdict.
Section 1. Company Snapshot. Let's get a baseline on Entergy.
So, Entergy is a massive, regulated, integrated energy company. They're headquartered down in New Orleans and operate right across the Gulf South. But here's the kicker, and why they've been making so many headlines lately. They are positioned squarely in the crosshairs of the upcoming AI data center boom. They are locking in massive hyperscale contracts right now. Currently, the market is valuing them at $112.22 a share, which gives this utility powerhouse a staggering market cap of over $51 billion.
Taking a quick look at their baseline financials, Entergy trades at a trailing PE ratio of 28.68, with a forward PE of 24.92. They offer a modest dividend yield of 2.29%, and that's supported by an earnings per share of $3.91. Operating in the regulated electric utilities industry, these numbers paint a pretty clear picture. This is a company priced for some serious future expectations.
Section 2. The Buffett lens. Let's talk moat and value.
First up, the economic moat. Entergy absolutely has a wide one. Being a regulated monopoly in its territories is great, but when you couple that with massive locked-in data center contracts from tech giants like Meta and Amazon, their business becomes highly defensible. The management team also appears honest and very capable. However, the risk rears its head when we peek at the balance sheet. They're carrying a high debt-to-equity ratio of 1.80. Now, to be fair, heavy debt is pretty standard practice for capital-intensive utilities, but it's a potential red flag for strict Buffett followers who love to see pristine balance sheets.
And this brilliantly illustrates the reality of the utility sector right now. Just look at that massive projected capital expenditure. Entergy has a staggering $38 billion five-year capital plan just to build out grid resilience and data center capacity. Because of this massive spend, their traditional free cash flow is deeply negative. So to calculate Buffett's favored owner earnings, we have to make an assumption here. We're going to use their net income of $1.7 billion as a proxy, specifically because all this CapEx is essentially required maintenance and growth investment bundled together into one massive package.
So, what's the verdict? Does Entergy meet Buffett's criteria? Well, they do have consistent earnings and a wide moat, for sure. But their return on equity sits at a moderate 10.75%. And like we said, that debt level is pretty high. Given these factors, Buffett would likely demand a much wider margin of safety. While the core business is definitely solid, a strict Buffett approach would mean waiting for a significant drop, probably to a target entry price of around $85 per share before pulling the trigger, just to bake in that necessary safety net. So for Buffett, it's a waiting game.
Section 3. The Lynch lens. Let's look at growth and valuations. Under Peter Lynch's famous categories, Entergy firmly fits the definition of a stalwart. It's a large, established entity providing reliable services and consistent dividends. But what makes this a fascinating narrative is that Entergy is actively trying to break out of that boring, slow-growth utility mold. They are aiming to accelerate their growth to a really impressive 8% compound annual growth rate, driven directly by those hyperscale data center contracts we talked about. But here's where things get a little tricky. When we apply Lynch's favorite valuation metric, the PEG ratio, which as a reminder is the price-to-earnings ratio divided by the growth rate, we kind of hit a wall. Taking their PE of 28.68 and dividing it by that projected 8% growth rate, we get a PEG ratio of 3.58. Lynch notoriously loved a PEG ratio of 1.0 or less, which represents growth at a reasonable price. A PEG of 3.58, that means you are paying a very steep premium for that anticipated growth. Furthermore, Lynch strongly favored companies that were largely ignored by Wall Street, and he loved seeing insiders buying up their own stock. Entergy has a massive 88.07% institutional ownership, so it's already a Wall Street darling. Worse still, recent filings show some significant insider selling. Specifically, an executive recently offloaded $1.17 million worth of shares. When you combine that high peg, the massive institutional ownership, and the insider selling, a strict Peter Lynch evaluation would result in a definitive sell or avoid opinion at these current levels.
Section 4. The Graham Lens. Time for some defensive value analysis.
Running Entergy through Benjamin Graham's defensive investor checklist yields a bit of a mixed bag. Adequate size? Check. Earnings and dividend stability? Check. They actually boast 12 years of dividend growth. But strong financial condition? That's a fail. Their current ratio is only 0.96. Moderate PE? That's a hard fail at 28.68. Now, to run his signature formula, we actually had to make a slight assumption to derive the book value per share. By utilizing the 10.75% ROE and $3.91 EPS from our data, we calculated a book value per share of $36.37.
And that brings us to Graham's famous intrinsic value formula. It's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. For a true defensive value investor, this formula is the ultimate, unforgiving acid test. It completely strips away all the glamorous growth narratives and looks purely at the historical, tangible, financial bedrock of the company.
Now, what's really interesting about this slide is the harsh reality of that result. Plugging in our numbers, Graham's intrinsic value comes out to a shockingly low $56.56. Remember, the stock is currently trading at $112.22. So at these levels, Benjamin Graham would absolutely not touch this stock. It offers zero margin of safety according to his deeply conservative, uncompromising metrics.
Section 5. DCF and Alternative Models.
Okay, so it's pretty clear the historical value gurus aren't exactly fans right now. But let's be fair. Utility pricing relies heavily on predictable, regulated cash flows, which makes modern quantitative models highly relevant here. Let's look at our base case discounted cash flow model. We forecasted out 5 years, assuming an 8% growth rate on their estimated $4.25 EPS. We used a standard utility weighted average cost of capital, our WACC, of 6%, alongside a conservative 2% terminal growth rate. Running all those numbers gives us a fair value per share of around $115. That is remarkably close to the current trading price. This suggests that if management actually hits those growth targets, the stock is fairly valued right now based on its future cash flows.
But let's look at a comparable company analysis to get a different perspective. Drawing directly from the Gabelli Phone's data in our sources, we see Entergy is trading at a forward PE of roughly 24.9. But its peers like Southern Company and WEC Energy are trading closer to 19 times forward earnings. Entergy is trading at a massive premium to its utility peers, almost entirely because of that AI data center narrative. If it were to revert back to the peer average multiple, the fair value drops significantly, down to roughly $77.
Let's apply one more framework, the dividend discount model. This one is literally tailor-made for utilities. If we assume Entergy simply maintains its historical 6% dividend growth rate, and we require an 8% cost of equity, the DDM calculates a fair value of $135.50. Under this specific income-focused model, Entergy actually looks undervalued, which really highlights the underlying strength of its reliable dividend payout.
Section 6. Synthesis and Final Verdict. Let's bring it all together. So, the crucial point is that we're looking at a tale of two philosophies here. The traditional stringent value models of Buffett, Lynch, and Graham see Entergy as severely expensive, and they demand a huge price drop before buying. The peer comparables also suggest it's overvalued, but the modern DCF based on future growth and the income-based DDM completely justify and even exceed the current premium price tag.
When we weigh this phenomenal industrial growth narrative, those massive data center tailwinds, and a very wide moat, against the stark reality of high debt, insider selling, and trading well above peer multiples, we have to find a balance. The growth story is real, absolutely, but the valuation is definitely stretched. Therefore, blending all these insights together, we are officially issuing a definitive hold recommendation for Entergy at its current price of $112.22. It's a great company, but you are paying full retail price for that greatness right now.
Which brings us to our final question for you to ponder. At what price point does ETR trigger a buy for your portfolio? Do you trust the explosive future growth story of the DCF, or do you stand with the historical value metrics demanding a much deeper discount? The data is in your hands now. Keep applying these frameworks, keep questioning the numbers, and I'll see you in the next explainer.